Hello everyone and welcome to our final Market Compass video for the year. I'm Angelo Kourkafas and today we'll look back at 2025 and share our key views for the year ahead. It's been an eventful 2025. Trade policy uncertainty rattled markets early on, but stocks staged the V-shaped rebound to new highs, powered by heavy AI investment and stellar corporate profits. Looking ahead, we expect another year of positive returns driven by steady economic growth, modest fiscal stimulus, likely more Fed easing, and rising earnings. But as we navigate now year 4 of this bull market, there are also potential risks, including periodic AI disappointments and lingering inflation. Let's dive into 4 key views. Growth was bumpy in 2025 amid trade disruptions, a slowing labor market, and a prolonged government shutdown. Nonetheless, the economy grew about 2%, which is what we expect for 2026. We expect tax refunds will support consumer spending early in the spring. Also, favorable tax treatment of investment may encourage businesses to spend, while the AI build-out continues and trade headwinds fade. One factor that may act as a speed limit on growth is the labor market, as low hiring, low firing conditions persist. We expect job gains to improve slightly, around 50 to 100,000 per month, but still remain muted compared to recent years. A smaller labor supply driven by a decline in immigration should keep unemployment near 4.5%. On the inflation front, tariffs have pushed goods prices higher, a trend that may persist in early 2026 before fading mid-year. The bigger story is services inflation, which makes up to 75% of core CPI and is slowly moderating. Overall, inflation is likely to stay above the Fed's 2% target, but improve slightly from 2025. With the labor market cooling on one end and price pressures still present on the other, we think the Fed will aim for a 3 to 3.5% policy rate as it approaches the end of its easing cycle. If growth holds as we expect and the Fed cut rates once or twice, the 10-year Treasury yield should stay range-bound near 4 to 4.5%. That could widen the yield advantage of bonds over cash, helping bonds outperform again in 2026. On the equity side, after 3 years of double-digit gains in the S&P, pushing valuations higher, 2026 will likely be all about earnings doing the heavy lifting. Returns may cool, but with no recession or Fed tightening in sight, we expect the bull market to keep going. Leadership, however, could shift. In 2025, growth beat value, and tech and communication services dominated performance for the 3rd straight year. AI could likely remain a major driver, but we see markets broadening both within tech and beyond tech, with solid earnings across sectors and regions. We expect the gap between tech and other sectors to narrow in the year ahead, favoring a balanced approach. 2026 looks promising, but risks like AI disappointments or lingering inflation could test the market's resilience. We think investors can consider the following. First, maintaining exposure to innovation and AI, but spreading risk. Second, broadening your opportunity set to include mid-caps, cyclicals, and international equities. Also, using bonds for still attractive income and portfolio stability. And lastly, reviewing excess cash allocations as yields decline with Fed rate cuts, weighing whether that cash could work harder elsewhere. For tailored advice to your specific situation, connect with your financial advisor to help ensure your portfolio is positioned for success in the new year. And for a full look at our 2026 annual outlook, visit edwardjones.com. happy holidays, and we'll see you in 2026.